Welcome to this explainer. Look, if you're passionate about long-term wealth creation, you already know that navigating today's complex real estate climate requires a lot more than just having the capital. It requires precision. So today, we're diving deep into the 2026 multifamily landscape to see exactly how disciplined investors are actively engineering their own outcomes. So, let me ask you this. Are you waiting for market clarity? Over the past couple of years, rising interest rates and record new supply have naturally made people hesitate. When all the macroeconomic headlines are screaming about uncertainty, the absolute most basic instinct is just to wait for the fog to clear. But what if waiting is actually the riskiest move you can make right now? What if the data is telling a completely different story for the folks who know exactly where to look? To answer that, we're going to follow the data. Here is our agenda for today. 1. Decoding market uncertainty. 2. The shifting supply pipeline. 3. The renter demand drivers. 4. The value-add advantage. 5. Engineering forced appreciation. And finally, 6. Execution over market timing. Let's jump into Section 1, Decoding Market Uncertainty, and finding opportunity within the noise. Every market cycle really produces two kinds of investors, the ones who sit on the sidelines and wait, and the ones who act. Now, the headline story recently has been all about a massive supply glut, right? Developers delivering this enormous wave of units between 2022 and 2024, which obviously puts some short-term pressure on Sunbelt rents. It sounds a little scary on the surface, but beneath those headlines, contrary investors are actually watching a totally different metric. They're seeing sharply declining construction starts, which means we're looking at a rapidly thinning pipeline for the years ahead. Moving on to Section 2, the shifting supply pipeline. A massive contraction in new starts. 70%. Just think about that number for a second. New construction starts for rental housing have dropped roughly 70% from their peak. So if you've been operating under the assumption that the market is just going to keep drowning in an unending supply glut, well, this fundamental shift completely shatters that narrative. Let's trace how this actually plays out chronologically. We definitely saw record new apartment deliveries from 2022 through 2024. But by 2025, those construction starts absolutely plunged, hitting their lowest volume in a decade. So what exactly happens in 2026? Well, existing demand naturally absorbs the units that are available, vacancies drop, the market tightens up, and rents are gradually pushed right back upward. That brings us to Section 3, the renter demand drivers and the home ownership gap. If you've even glanced at mortgage rates lately, you already know this financial reality. Buying a home right now remains significantly more expensive on a monthly basis than renting a comparable unit. The gap between owning and renting is just extraordinarily wide right now. And when you add the fact that wages have actually risen faster than rents over the past 3 years, you're left with this massive, durable pool of high-earning professionals who are firmly planted in the rental market. So who exactly is the modern renter? It's not necessarily who it used to be. We're talking about high-earning professionals who could theoretically afford to buy, but they actively choose to rent for the flexibility it offers. They are renting for longer periods, and crucially, they are absolutely willing to pay a premium for quality. For investors, this demographic creates the literal ideal customer base for upgraded, value-add operators. And that segues perfectly into Section 4, the value-add advantage. Why this strategy wins now. Picture all those brand new Class A buildings popping up around town. To just get tenants in the door, they have to compete so aggressively, giving away heavy concessions and free months of rent. It's a tough spot to be in. Value-add properties, on the other hand, play a much smarter game. By taking well-located but slightly older properties and strategically upgrading their dated finishes and fixing deferred maintenance, operators can offer a highly desirable product at a really attractive price point. This generates superior risk-adjusted returns without dealing with all the friction of a new luxury lease-up. And look, this isn't just some niche theory we're talking about here. 35% of institutional investors currently favor value-add and core-plus strategies. Institutional capital allocators, literally the smartest money in the room, agree that moderating new supply makes value-add the definitive strategy heading into 2026. Section 5, Engineering Forced Appreciation and Controlling the Outcome. Here is a concept that is absolutely crucial to understand: forced appreciation. Basically, this means increasing a property's net operating income, its NOI, and its overall value through precise operational execution and physical improvements. You're not just waiting around for market inflation to bail you out. You certainly aren't crossing your fingers and praying for interest rates to drop. You are actively taking control and engineering the asset's value yourself. To put that into perspective, let's break down a real-world example using Deco Capital's playbook. It's a super disciplined three-step process. Step 1, identify properties with clear operational upside, like below-market rents or inefficient management. Step 2, execute a rigorous, highly disciplined renovation and management plan to really improve the community. And Step 3, naturally increase that net operating income, which directly drives up the overall value of the asset. It's active, it's hands-on, and it is highly engineered. Let's wrap up with Section 6, Execution over Market Timing, how discipline separates operators from speculators.
Let's be totally clear here. The era of easy money is firmly over. In recent years, well, let's call them what they were, market speculators. They survived by over-leveraging, over-projecting rent growth, and relying entirely on a hot macroeconomic market lift to save them. But the minute the market shifted, they drowned. Disciplined operators, though, they underwrite conservatively, they manage their assets incredibly tightly, and they extract yield strictly through operational excellence. If you are serious about passive income today, partnering with an operator who actually has the real-world capability to execute is the only reliable path forward.
It all boils down to a complete mindset shift. You're not betting on the market. You're engineering the outcome. Sophisticated investors simply do not treat real estate like a casino hoping to get lucky. Instead, they partner with teams who have identified executable upside and actually possess the rigorous discipline to deliver on it. You know, uncertainty doesn't eliminate opportunity, it just concentrates it for the people willing to put in the work. The supply pipeline is contracting, renter demand is rock solid, and value-add opportunities are absolutely prime right now. So I'll leave you with this final thought. Are you waiting for the market to magically get easier, or are you ready to partner with disciplined operators and engineer your own generational wealth? Stop waiting for perfect clarity and start focusing on execution.